Hey founders, have you launched a business you loved only to get bogged down by accounting, payroll, investor relations, tax filings, and even grant proposals? Well, in this week's episode of Making Billions, I bring on my dear friend Waseem Daher from Pilot.com. Waseem is a 3-time ultrapreneur that has nailed it on 8-figure exits with Oracle and DropBox. He literally built a tech-enabled accounting firm that focuses on all the issues founders need, providing that steady hand all along the way. He loves our show so much that he's offered a promo for our listeners on their services. Just go to pilot.com/billions to sign up for a promo offer. Getting your numbers right while executing on solid financial management are all skills we need in our pursuit of making billions. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Waseem Daher. Waseem is a 3-time entrepreneur that has sold his previous 2 startups to Oracle and DropBox. He is now the CEO and founder of Pilot.com, a tech-enabled accounting firm that specializes in supporting startups. His company has such investors like Sequoia, Stripe, and get this, even Jeff Bezos himself has invested in this guy. So what this means is Waseem has built Pilot.com to impressive levels and is about to talk about how you can do the same with Pilot.com on your side. So Waseem, welcome to the show, man.
Ryan, thanks for having me. I've always been a fan of what you've been up to here. So great to be here.
Yeah, it's great to have you on the show. And, you know, I know you've done all these wonderful things and have accomplished so many things. But I think a lot of our entrepreneurs around the world would love, like, where did it begin for you? And maybe we can talk about the stuff after that.
Sure.
So where did it begin for you?
Yeah, I mean, for me, I think the origin story, if you like, really starts at MIT, where I'd studied computer science as an undergrad. And the reason it began there is that's where I met my co-founders, my now 3-time co-founders. We were all studying computer science together. To make it even nerdier, we were actually all in the computer club together. So we've done projects, we've done classes, or just like sort of a really tight-knit social connection. And then one of my co-founders, his master's thesis was actually some technology that could take software updates and apply them without rebooting. I'm sure you've seen that pop up. It's like, you must reboot. Well, he had invented some tech where basically we could go and transform those updates so you could apply them on a running system, which is important for like server farms, et cetera, et cetera. And this was 2008. It was like, you know, the economic crisis had kind of just hit. We knew nothing about running a company, but we're like, this seems promising. Like, we want to get this out into the world. So we said, fine, we're going to do a startup together. We all like moved into a crappy little row house in Cambridge and ate a lot of ramen. It was just like, the whole thing was extremely scrappy. And it was like a kind of very hard learned MBA, basically. We learned a lot from really figuring out how to operate that first company. And fortunately, the story ends well. Oracle acquired the company after about 3 years. We had grown the business to something like 7 figures in annual recurring revenue. Oracle had bought the company because they were interested in the tech. And so we were all there. They kind of came on board. We were there for a year and a day before we decided, hey, look, we are feeling the itch again. We want to start the next thing, kind of same founding team, get the band back together. The second company was a group chat tool for businesses. This was, I think, like August 2012 or so. So we were building a Slack-like product at a time when Slack was, I think, still making a mobile game or something. It was like the conventional wisdom at the time was, no, there really isn't room for a good business chat tool. Now, like, obviously that was false. I think we were a little early. I think there were some things we would have done differently from an execution standpoint in retrospect. But all's well that ends well. Again, Dropbox acquired the company. The whole gang moved out to San Francisco to join up the team there. We were there for about 2 years working on product and engineering. And then we left, again, getting the band back together to really start what I like to describe as our third and final company, Pilot, where we do accounting for startups.
Wow. And what did, I don't know how much you're willing to share, but what did, at least in the range, what did you sell those companies for?
Sure. So we don't disclose the details, but I'll give you kind of the ballpark to give you a sense. For both of them, they were 8-figure exits. And in particular, for the first one, I mean, it was really material and really life-changing precisely because we had bootstrapped it. We had owned 100% of the company. So if you look at kind of where those dollars went to the shareholders of the company, namely the folks that were there.
You've done it. You've been through all the highs and lows of startups, and you're just crazy enough to do it not only 2 times, but now your 3rd time you're doing it. But what this does, at least from my perspective on the outside of Pilot.com, is that knowledge and information. You are bringing all of those lessons learned from startups, founders, what they go through, all the way from launching your first round to closing your round to exiting and operating. I mean, there's a lot of stuff, and it all intersects in finance. I don't have to tell you that, but this is something that really non-financial founders may not realize how important it is until they realize how important it is. And you're right there in the crosshairs of all of that. So maybe you could talk a little bit about, now that you've got Jeff Bezos and all these guys that are backing you and you're doing these wonderful things. Obviously, we would consider your current backers quite smart in their industry. Sequoia, Stripe, Jeff Bezos, they probably understand when they see a good business. They saw your business and they said, there's something here. So maybe we could talk a little bit about what Pilot.com is, what it does, and what are the benefits to a lot of entrepreneurs starting out.
So what is Pilot.com? We're an accounting firm. And we're an accounting firm that is really laser focused on working with startup companies, ranging from, let's say, like 2 folks in a garage that would just raise a little bit of money, all the way to companies that might have 300 plus people and have a full-time VP of finance and controller, CFO, all that stuff. And the way we do it is we pair you with our in-house expert team. We employ a bunch of really talented accountants that literally sit in our offices. And under the hood, our engineering team has sort of built the Iron Man suit, if you like, software that we use internally to help do the work more accurately, more reliably, more consistently. And the net of that is you actually have really good visibility into the health of the business, into where things are going. You've got a handle on taxes. Like, the reason that we started this company in the first place is because this was so painful for us in our previous ventures. Again, in the first company we bootstrapped, I literally did all this stuff by hand. I think the thing that was mind-boggling is the status quo today is you go and you hire a talented accountant and, they're a genius. They've got all this kind of like mental energy and capacity that they could be using to making your business more successful. But instead, what you have them doing is like clicking around in QuickBooks a ton, doing really mechanical pieces of the work. And so the insight was, the accounting job is actually 2 pieces. There's like the smart, tricky, kind of error-prone aspects of it. There's like the kind of like real intelligence and context part. And then there's the kind of mechanical transformation piece. And today, both of those pieces are done by a person. And our insight was, look, everyone has this problem. We can do it better, more accurately, more reliably, more intelligently, more scalably if we're smart about having people do the things that should be people and having software that we use internally do the things that should be software. And ultimately, the way we package this up is not, oh, here's a piece of software that you go and buy and use. And the reason that we don't do that is because I've never, ever met an entrepreneur who has said, I can't wait to buy accounting software. Like, no, what the founder, what the business owner wants, and what we wanted was, I want to know that I've got someone smart thinking about this that is taking care of this for me. And so we're kind of a strange business. Like, we're really a tech-enabled accounting firm, which is a bit unusual.
Yeah, but you've reversed engineered, knowing, like you said before, you're like, we know how painful this can be for a lot of entrepreneurs. So we understand those pain points. And like any true entrepreneur, you become obsessed with a pain point or a problem, and you want to solve that for the rest of the world. And so you reverse engineered an accounting services firm to say, let's build these products. Let's build a firm that addresses the key problems that entrepreneurs go through that we know darn well because we went through it ourselves, right? We know what investors are going to want to see. We know what, cash flow problems you're going to have. We know all of these different issues that you're going to face, and at different phases of your business, the problem changes. As they say, every new level's got a new devil. So as you start leveling up through your company, you're going to have different issues that you're going to need to solve that wasn't an issue before. And who better to guide you along that process and that growth process than someone who's been through it and then built an accounting firm to address every one of those things. So in other words, you help founders look around corners. So speaking of that, I've been on your website. I've been on Pilot.com. I've noticed you've done a very good job at really simplifying the three key pillars. You have Pilot bookkeeping, Pilot CFO services, and Pilot tax. So maybe you can just address a few of those areas and really why would an entrepreneur care or hire you for any of those or all of those or none?
So let's first talk about kind of like why you might work with a firm in general, and then also the specific components you mentioned, the bookkeeping, the CFO, and the tax prep. And the reason to hire an expert here is one, it's probably not the area of expertise of you, the founder, or you, the business owner. And two, your scarcest resource, like of course dollars are scarce, but time is even scarcer. So if you can actually lean on an expert to take care of this stuff for you, knowing that it's going to be even higher quality than if you'd done it yourself, that to me feels like a pretty compelling value proposition. And what's interesting is the people who most get it, or the people where this sort of most resonates, is actually the second time founder. Because the second time founder is like, oh God, I made this mistake previously. I'm not going to, Waseem, like just have Pilot take care of this stuff for me. And we talk about, okay, fine, this stuff, what do we actually mean? I think there are really three components. There's the kind of bookkeeping piece, there's the fractional CFO piece, and there's the tax piece. And well, what is bookkeeping? Bookkeeping in its most simplistic form, it's really just describing how money has moved in and out of the business. So like how much revenue do we generate this month and like from what line items? And then what did we spend this month and in what categories? How much of this was payroll? How much of this was office expenses or travel or whatever? So you produce basically the three financial statements, the balance sheet, the profit and loss, and the statement of cash flows. And that lets you and your investors, probably most importantly, really just get a quick snapshot of the health of the business. Like what is going on with the business? But it's a very backwards looking thing. So bookkeeping tells you, it's kind of like the log. It tells you where you've been. Now, where the fractional CFO comes in or the CFO services come in is much, much more forward looking. It's like, cool, where are we going to go? Let's have a budget. Let's have forecasts for our key metrics. Let's really come up with a plan to make sure we understand when we're going to run out of money, what we're going to do with it. Like the CFO's job is much, much more forward looking, whereas the bookkeeping, while really critical, is more like you're looking in the rearview mirror. And then the third component is the tax component. The tax component, the answer is actually here's very easy, which is you have to do your taxes. Like the government will send you a series of increasingly scary letters if you don't kind of follow through on those obligations. And so I think those are the kind of three components of what I think of as like the financial back office. It's the production of the financial statements, that bookkeeping work. It's the kind of more strategic, forward-looking CFO piece. And then there, of course, there's the tax piece that you just have to deal with.
So that being said, so you have entrepreneurs, you help them all the way from looking back and telling you what did happen. Now, obviously, you and I both know, and everyone listening, entrepreneur has a pretty good sense of what did happen. But where that matters for anybody that's questioning that is saying it's not necessarily for the entrepreneur. I mean, it is, but you got to think like the CFO is saying forward-looking. Investors are going to want to know, where did this business come from? It's the investors. And when investors start poking around, and the episode that we had last week was on data rooms, they're going to want to poke around in your data room and say, hey, show me your financial statements. It's okay. I just want to know through an accurate assessment of where did your business go, and then we can extrapolate from that on where we think it's going. And that's where your CFO services come in, is to say, well, if you want to go forward looking, if we want to really nail it on your next future rounds, you got to get your numbers right. Would you agree?
Absolutely. I mean, one of the things, this is again, I think why this is a real second time founder lesson. At our very first company, we did this stuff ourselves, which again, we learned a lot, but was not a good use of our time. And at one point, a potential acquirer was like, hey, send us your financial statements. And we were like, oh crap, like it was a fire drill to like assemble something together at the last moment. Like maybe it was correct, maybe it wasn't. It's like, that's a huge miss. If you have just been diligent about keeping this stuff up to date, it is useful to you, the business owner. It is useful in the go forward stuff because you can't forecast if you don't have reliable data about the history. And then importantly, your investors and your potential investors are going to care deeply about, look, do they have their act together on this stuff?
As we round third base, I'm wondering, like, from your experience, your vast and impressive experience dealing with high-level investors, doing some well-known or exits with some well-known players, What are some of those? Do you have two or three tips that now looking back that you can give to our investors or our listeners or anybody who's listening to the show? What are some of those pointers that maybe your experience can provide to help the next gen?
Yeah, I wanted to really distill this down to just like a couple really tactical things that you could just do today that hopefully will actually really move the needle for the business. And the first is if you just raised money or if you have a bunch of money in the bank, it's shocking to me that this is the case. Most founders just have that living in the company's checking account and it's making literally 0% interest. And if you just call up your bank and say, hey, I want to invest that in treasury bills, like something super, ultra conservative, like this is not a risky move, you can get something today like 4.5% on that. And, 4.5% of $1 million, that's 45K. That's real money. So that's like a quick phone call can actually really materially potentially extend the runway of the business if you have cash that's kind of sitting there. Now, importantly, like don't go put that in like crazy stocks or whatever. You want to do something really conservative, but like one quick phone call, literally there's just like some free money that you could be getting that you're not currently getting. So that's definitely tip number one. Like right after listening to the pod, you should just like check on this if that's the situation you find yourself in. The second is kind of a business model point. And, I talked about this a fair bit, Ryan, before the show, which is like the importance of recurring revenue. And I think a lot of people get, subscription model, like there's a lot to like about it. And absolutely, like recurring revenue is so key to making a business successful. But I actually want to add one more point kind of to go even deeper on that, which is the importance of annual prepayments. And this seems like it doesn't really matter. Like everyone's like, oh, okay, I've got my website, I've got my annual plan and my monthly plan costs 20% more. Like, cool. What I would say is the annual plan is much, much, much more valuable to the business than the monthly plan. And here's why. For any business of any kind, there's this kind of like upfront cost of acquiring the customer, of getting the customer set up, of like getting the thing going. And generally speaking, for these businesses, your actual cost to get the customer on board is greater than the cost of their 1 month payment or whatever. So in the early days of the customer's lifetime, they're actually consuming cash from your business. You're in some ways kind of paying them to get them on board. And the reason you're doing that is over time, you make that back and then they become a profitable customer for you. But now if they pay monthly, it consumes cash from you on day one. Whereas if they prepay annually, you're getting all of that cash up front. The customer generates cash flow for you on day one. And the reason that matters is if you're growing rapidly. If you're growing rapidly and you're adding more and more customers every single month, well, again, in the monthly world, what's happening is you're actually spending more and more dollars every single month. And you need to make up that dollar shortfall somehow. And the way you do that is you raise money from investors. So when customers pay you monthly, your growth in some ways is financed by investors. Whereas if your customers prepay you annually, your growth is financed by those customers. That's much more interesting because cool, your customers are helping you grow your business. Whereas in the monthly payments, you're selling equity, probably like one of the most expensive pieces of, or most expensive ways to raise money to allow the business to be successful. So again, it seems like a wonky technical point, and it kind of is, but it has real implications about kind of the growth and the sustainability of the business. So the importance of annual prepayments is probably the second point I'd mentioned.
I noticed you and I were talking a little bit, and you mentioned something about, in the U.S. they have an R&D tax credit. Maybe you can speak a little bit about that and how what's the benefit to entrepreneurs, and also how does Pilot help entrepreneurs get a piece of that?
Absolutely. So the third thing that I definitely recommend startups look into is this thing called the R&D tax credit. And what's interesting is that for most startups, in particular, kind of most funded startups or venture-backed startups, tax credits tend not to be that interesting. And that's usually because tax credits offset companies' corporate income taxes. And these companies in the early days are usually not profitable. So it takes your tax bill from being $0 to still being $0 and consumes a bunch of time. The thing that's unique about this R&D tax credit is it lets you offset payroll tax, which you have to pay when you employ anyone, regardless of how profitable or not profitable the business is. And so the story with the R&D tax credit is basically, if your company is doing what's called qualified R&D, and there's a 4-part test to determine whether you're doing qualified R&D, you can get this tax credit that you can use to offset payroll taxes just by virtue of having done that work. And of course, there's a process and you want to do it super rigorously. So if anyone comes knocking on the door, like you have good documentation and verification. And Pilot, we have an R&D tax credit offering that helps our companies get that done. And the credit potential here, it depends on how much you're spending on R&D, but it's literally, you could save up to $500K on payroll tax you don't have to pay anymore because you're offsetting it with this credit. So again, there's real found money here that startups are probably qualifying for anyway by virtue of doing what they're doing, and just needs to take advantage of.
So as you know, this has been phenomenal advice. So I mean, we've got fans in 100 countries around the world listening to this, and so especially a majority of it is in the United States, but we're all over the world, and following these advice. So just to recap, as we wrap things up, find a professional that can help you get these things like Pilot.com, who can really help you to navigate this ship in entrepreneurship. The other thing is there are just better places to park your capital. So once you close out a round, and you have this nice wave of liquidity that comes into your company, find better places to put it. So, T-bills, I think you mentioned, are a good place, but, talk to your banker and really figure out what's right for you. But the point is, there's better places that can really result in improving working capital. And finally, just the revenue recognition model, or just improving your revenue profile and getting those prepaid subscriptions or an annual prepayment tends to boost your profile. And specifically, I like what Waseem mentioned, was this helps you. There's a phenomenon in startups called growing broke, right? You can grow too fast and go broke because the draw on your working capital is so substantial that it can actually implode your company. We're not saying it will happen, but we're just saying be aware of that if you aren't already. And one of those ways to combat growing broke is prepaid annual subscriptions and revenue models. Those help to bring in the working capital, bring in the capital you need, the growth capital, without having to tap into more expensive sources of capital to bridge that, meaning bridge loans, mezz financing, and the most expensive would be equity financing. You do these things, and you too will be well on your way in your pursuit of making billions.